Okay, let's be real. When you're getting a home loan, the mountain of paperwork is just overwhelming. But the scary part is, hidden deep in that fine print, some lenders can set some pretty nasty traps. So knowing your rights isn't just a good idea, it's your absolute best defense. Today, we are diving into one of the most important shields you have, the HOPEA regulation.
I mean, it's a terrifying thought, right? You believe you found a great deal on a loan, you sign the papers, only to find out way too late that the terms are actually designed to work against you. This is the nightmare scenario for so many people who get caught in the web of predatory lending. And that really gets to the heart of it. Predatory lending isn't just about a high interest rate. No, it's about systematically trapping borrowers in loans they can't possibly afford, using terms that are just fundamentally unfair. And this is exactly why a specific safeguard had to be put in place.
So, let's meet the guardian angel in this story. HOEPA, that stands for the Home Ownership and Equity Protection Act. You can think of it as a powerful shield created specifically to protect homeowners from these kinds of predatory financial attacks. So what is it really? Well, HOEPA is a federal law that basically puts a giant spotlight on certain mortgages that it calls high cost. And for those loans, it says, whoa, hold on a minute. If you're going to offer this kind of loan, you have to follow a very strict set of rules. It's an extra layer of security just for you. Now, this is a super important point. HOEPA doesn't cover every single mortgage out there. Its main focus is on what are called non-purchase transactions. So we're talking about refinancing the mortgage you already have or maybe taking out a home equity loan. It generally doesn't apply to the loan you get to first buy a house or a construction loan or even a reverse mortgage. Okay, so this brings us to the most crucial question. How in the world do you know if a loan is actually covered by HOEPA? Well, the law sets up 3 very specific tests, or what we call triggers. If a loan trips any one of these wires, boom, it's officially a high-cost loan, and all of HOEPA's protections kick in immediately. And don't worry about memorizing some complicated legal jargon. To make this super easy to remember, we have a fantastic little memory aid. Just think of the word app, like an app on your phone. It stands for the 3 tests we're about to break down. And here they are. The A stands for the APR test. The first P is for the points and fees test. And that second P, that's for the prepayment penalty test. So let's dive in and see how each one of these actually works. First up, the APR test. This one is pretty straightforward. It flags a loan if its annual percentage rate, or APR, is just way too high compared to the market average. For a typical first mortgage on a home, if the rate is more than 6.5 percentage points above the average, that's a trigger. For smaller loans, or for a second mortgage like a home equity loan, the trigger is even higher, at 8.5% above average. Next is the points and fees test. This is all about the upfront cost you're being charged. For most loans, if the fees you're paying are more than 5% of the total loan amount, that's a huge red flag and a HOEPA trigger. And check this out, this is what's so great about this rule. For smaller loans, under $50,000, the threshold is even stricter. This is so important because it protects smaller borrowers from getting absolutely buried in fees. And the final trigger in our A.P.P. acronym is the prepayment penalty. That's the fee some lenders charge you for paying off your loan early. Under HOEPA, a loan is flagged as high cost if the lender can charge you this penalty for more than 3 years or if the penalty is more than 2% of what you paid off. It's all about making sure you're not trapped in a bad loan for years and years. Okay, so let's say a loan hits one of those A.P.P. triggers. Now what happens? Well, this is where HOEPA really starts to flex its muscles. The law establishes a clear list of prohibited plays, things that lenders are absolutely 100% forbidden from doing if they're giving you a high-cost loan.
And you guessed it, we have another fantastic memory aid for this one. If a practice is prohibited under HOEPA, just remember that it is officially banned. Every single letter in that word stands for a specific rule that's there to protect you. Let's walk through it. B is for balloon payments. These are loans where you have this massive single payment due at the very end. It's often impossible to afford and a direct path to foreclosure. Banned. A is for ability to repay. Lenders can't just hand you a loan. They are required to verify you can actually afford the payments. Next, N is for no negative amortization. This is a crazy trap where your payments are so low they don't even cover the interest, so your loan balance gets bigger every month. You're paying, but getting deeper in debt. Banned.
The second N means no financing of points and fees. This means they can't just roll their own fees into your new loan when you refinance. E is for those excessive penalties we talked about. And finally, D is for default steering. Lenders can't push you into one of these expensive loans if you actually qualified for a better one. So, beyond banning all those bad practices, HOEPA gives you one final, incredibly powerful safeguard. You have to be told what's going on. The law makes sure you get a crystal clear warning before you ever sign on that dotted line. This is the exact warning lenders have to give you in writing. It's not buried in legalese. The language is direct and, honestly, a little scary for a reason. It is designed to make you stop, take a breath, and consider the most serious possible outcome: losing your home. And it's not just what they tell you, it's when they tell you. You absolutely must receive these special disclosures at least 3 business days before you are scheduled to close. I like to call this the 3 before keys rule. It's a mandatory cooling-off period, giving you time to read, think, get advice, and back out if something feels wrong, all without any high-pressure sales tactics. So, to wrap this all up, here is your HOEPA cheat sheet. Just remember, HOEPA is your protection against abusive loans. You can spot them by looking for the A.P.P. triggers. You know your rights by remembering the list of banned practices. And your final line of defense is that all-important 3 before keys disclosure rule. Knowing all these rules is a huge first step, but actually using them in the real world, well, that's the real challenge. It leaves us with a really important question to think about. Even with all these protections in place, which one of these predatory tactics do you think would be the hardest for an everyday person to recognize before it's just too late? Definitely something to keep in mind.